Welcome back to the Renegade Investor Academy. What I want to talk about today is UK pensions and all the changes that have happened in the last decade and how complicated it's all become and why you need to be on top of your whole pension situation to avoid some draconian penalties. Now, I must start with the usual disclaimer. I'm not qualified to give you tax advice, so this is for information, education only. This is not tax advice. You must speak to a professional if you want to get tax advice for your particular situation. But I think the reason why pensions have become such a political football in the UK is that the allowances, the tax benefits of pensions, cost the Treasury £35 billion a year. So at the best of times, the Treasury is always looking for ways in which it can save money or raise money. In a post-pandemic Britain, obviously the government is even more broke than it was before. So they're always going to be looking for how they can trim these benefits, how they can keep more of our money as tax or find new ways to tax us. If you look at the history over the last decade, there's been a very clear direction of travel, both in the amount we can contribute to our pensions and the maximum amount we are allowed to hold. Now, for me, the very concept of limiting the amount someone can have in their pension is completely bizarre. Surely you would think the government would want us to be as independent of relying on the state as possible. Because if we are forced to rely on the state, then we're going to increase the burden on the taxpayer even more. So you'd imagine they'd want us to save as much as possible so that we wouldn't have to do that. But no, they want to put limits on what you are allowed to have in your pension and therefore arguably on the sort of life you're allowed to live in retirement. Now, as basically a libertarian, I find that deeply offensive because for me, okay, you might put a limit on the tax benefits, but to say that there's a limit on your pension and the maximum you could have in it, that starts to limit or disincentivize you to make investments or to have a successful investment portfolio. Because one person, let's say, saving purely cash in their pension with 1% interest rates is going to never get near £1 million lifetime limit. But somebody who's made smart investment decisions, I think about, say, for example, Lord Lee of Trafford, who's managed his own ISA portfolio and built up a 5 million plus tax-free portfolio there. Imagine if he was doing that in a pension, he would crush that £1 million limit in 5 or 10 years. So why should he be penalized for being good at making investment decisions? It just doesn't make any sense. But of course, then we might need financial education, and we know that governments don't want us to be financially literate. So the starting point to think about in all this is they feel that they're giving too much away in pension benefits, and they want to find ways of clawing those back. If you look back to 2011, 10 years ago, you could put £255,000 a year into your pension. £250,000 a year could go in. So if you had a great year in your business, you could put a huge bung into the pension scheme. If you had a big bonus in your salary, whatever kind of work you were doing, that was there as a potential for you. That was slashed from 255,000 to 50,000 a year in 2011. And then the concept of a lifetime limit was introduced the following year. So almost a decade ago, we had a lifetime limit of 1.8 million. Now, just inflation rises alone would have brought that up to circa 2 million, maybe more than that. Today, the lifetime limit is half that amount. So in 2012, it came down to 1.5 million. A couple of years later, it came down to 1.25 million lifetime limit or lifetime allowance, LTA, and the amount you could put in each year was squeezed even further down from 50,000 a year to 40,000 a year. Fast forward another 2 years and hey, I think I can see a bit of a pattern emerging here. it went down again to from 1.25 million to just a million. And then they eventually graciously decided to add inflation to it. So it crept up from 1 million to 1.073 million, where as a result of this year's budget, it's now going to stay for the next 5 years. 5 years, incidentally, in which I think we'll start to see a huge uptick in inflation. So the effect of not having it inflation linked is going to be far worse over the next 5 years than it would have been historically, I think, over the last 5 years. So where do we stand today? You have a maximum amount you can have in your pension of 1.073 million, and the most you can put in is 40,000 a year across any and all pensions that you have, because many people end up with more than one. There might be more than one SIP. You may have a SIP and a SAS. You may have a SIP and an occupational pension. 40,000 across all of those schemes is the maximum. However, if you're one of those, socially unacceptable people who actually makes a lot of money and you start earning over £150,000 a year, that's obviously far too much for your own good. So the government penalises you by reducing the amount that you can put into your pension. So it starts tapering down to just £10,000 a year for some of our highest earners. So again, for me, that's a very kind of socialist, wealth redistributive policy that I really think, again, penalises saving and penalises earning. And don't forget, these people are already hammered on income tax. That is one of the worst things you can do in this country, is to earn around 120 to 150,000 a year. You'll be paying an effective tax rate of something like 60%. So not only do you have to pay that, you then get hammered on your pension contributions, which get reduced progressively down to just 10,000 a year. And God help you if you've taken even £1 out of your pension once you're over 55 or 56 or 57, that age is going to keep going up, then you come into something called the money purchase allowance. Now, okay, there's a legitimate reason why this was introduced. If you took money out of your pension and then kept putting it back in or putting new money in to get further tax relief when you're actually in drawdown, they felt that was cheating the system a bit. I can see the rationale for that. But the penalty, look at that, you lose 90% of your ability to contribute the second you start taking either a lump sum or any income out of your pension. So think very carefully before going into drawdown or taking your tax-free lump sum, because if you are still running your business and you're still thinking you might want to keep topping up those contributions, you can't. Once you've started taking money out, it gets slashed to kind of beer money of 4,000 a year, which is not going to make any material difference to a pension of that scale. So what happens if you go above those kind of limits? Well, that's conveniently placed in red here. If you contribute more than 40,000 a year, you will pay a tax penalty on that at your highest rate of income tax. So that could be 45% penalty if you accidentally go over the annual contribution limit. If you go over the lifetime allowance and then make a withdrawal of a lump sum, you will pay an outrageous 55% tax. So if you've gone over by 100,000 and you withdraw that 100,000, you'll be left with 45,000 of that lump sum. If you take it out as income, you'll still pay another 25% tax penalty on it. And don't forget, everything you take out your pension counts as income. So this is a penalty on top of ordinary income tax if you start withdrawing money that went over the lifetime limit. And guess what? As the lifetime limit has come down, the number of people caught in this cynical tax trap has increased. So if we go back 10 years, there was 37 million paid in penalties. If you go back 5 years, there was 93 million paid in penalties. The most recent year for which we have data is 2017-18, in which 4,550 people were caught in this trap, and they were hammered for £185 million in penalties. That is only going to go up massively with this 5-year freeze. You see, it's so clever, this. It means they can avoid scenarios where they're seen to increase taxes, but the net effect is, of course, that they do, and they also increase the penalties. So according to the latest figures, at the moment, 290,000 people are already over the lifetime limit. And by the time they retire, 1.25 million people will be caught in this particular tax trap. So I've talked before about this concept of fiscal drag. And what we have here is fiscal drag on an epic scale, because by everything being frozen for 5 years and heading to a time of increased inflation, millions of people are going to end up paying more tax than they thought they were going to, being caught in traps like this, or indeed going over the contribution limits. So that's the kind of backdrop to all of this. Now, in terms of getting to that lifetime limit, so many people these days think £1 million is a lot of money. And yeah, of course, if you're on minimum wage or if you have no assets at all, it is a lot of money. But it's remarkably easy, and has never been easier, to get to £1 million generally in your net worth or indeed in your pension. So let's use some figures from James Hambro and Partners to show how that could work depending on the investment returns that you achieve. So if you today have got 500,000 in your pension pot, if you're only achieving 3% returns on your investment portfolio, it's going to take 25 years for that to double up to the lifetime limit. So if you were, say, 45 now, you'd be 70 by the time you hit that limit if you're only achieving 3%. But of course, with compounding and with everything else to do with returns, if you can nudge that percentage up, it makes a massive difference to how long it takes. So if you can go up from 3% to a very achievable 5%, if you look back over the last 20 or 30 years of the stock market, you'd have to have made some pretty poor decisions not to average 5%. So that would get you from 500,000 to £1 million in just 15 years. So if you're 50 now and you're thinking of retiring at 65, you are in danger of breaching that lifetime limit if you're averaging a 5% return. If you're at the higher end of investment returns, and this is certainly, again, eminently achievable with a 7% per annum average. In fact, a lot of forecasts you get from financial advisors and the like assume 7% as if it was routine. Well, it's far from routine, but if you're a smart investor and you really manage your portfolio well, you could probably achieve that kind of return, and then you'd get from 500,000 to £1 million in just over a decade. So you could be 55, 58 now, and still get to this sort of figure by the time you're in your mid to late 60s. So it becomes a real live issue for you. If you've already done a bit better than that, if you've got, say, 700,000 in there, you're going to get to £1 million in just 14 years, even with fairly mediocre investment returns of 3%. Get it up to 5%, and you're going to be down to just 8 years to breach the lifetime limit. Manage the 7%, and it's now just 6 years. So you could be 60 now, and if you're achieving 7% on that return, you're in danger of breaching that lifetime limit within this freeze period up to 2026. If you're almost there anyway, with say 900,000, you've only got between 6 or perhaps a couple of years before you'll be breaching the limit, and you've really now got to start looking very carefully, maybe even having to sell perfectly good investments and go into something rubbish like cash or bonds just to stop breaching the limit and getting a 55% penalty. So, this is such a bonkers set of distorted incentives that, for me, people should be congratulated on reaching £1 million in their pension, not penalised. What kind of thinking is this? Let's go to the other end of the spectrum. What if you've got nothing in your pension? What if you're a 21-year-old graduate starting your first job? You probably think £1 million, never going to happen. Fantasy land. Well, if you were saving Okay, 17% of your income, that's about double what you would normally do in an employer's pension scheme, an auto-enrollment pension scheme. Let's assume you earn the average salary of $29,000 a year and that you're willing to save 17% of that. If you only average 3% returns, you would get there when you were 68. So, and believe me, by the time you're 68, you'll be lucky if you can retire before you're 70. So 68 may seem a terribly old age. For those of us who are quite close to that, of course, it's the new 40. But even so, by the time you achieve retirement, you would be in breach of this kind of lifetime limit. Now, if you're smart and you're part of Renegade Investor Academy and you're taking all this stuff on and you're investing well, you could slash that down to maybe 28 years. So you'd only be 49 when you had £1 million. If you get up to what the best investors are achieving and you're averaging 7% plus, you could do it in 20 years. So by the time you're barely turning 40, you could be a millionaire. So, these kind of figures sound like they're challenging and hard to achieve. All it needs is a combination of the right habits and the right financial education and the right investment decisions. And of course, there'll be ups and downs. The stock market has ups and downs. We're probably due a crash anytime soon, although I've been saying that for a few years and it hasn't happened yet, but we'll see. 95% of fund managers all agree exactly with the same forecast of what's going to happen. That should make you worried. But regardless of all those ups and downs, smart people are going to get to this limit in anything from a few years to maybe 20 years. It's not a realistic limit for good investors. So what happens when you get to this limit? Well, if you were to take the annuity route, now annuities went out of fashion a few years ago, mainly because with bond prices being so low, you have to have a lot of capital to get a little income. At the moment, the best deals around on the market, if you were in this kind of self-managed, what they call defined contribution pension, where the only thing that's certain is how much you're putting in, and you have to become your own fund manager to work out what eventually you're going to have in your pot. Let's assume you've been successful, you've got to your £1 million lifetime allowance. The best deal on the market at the moment, if you put all that money into the annuity, would get you, if you're a healthy 65-year-old, like say me, you would get £33,566 a year, which, it's okay. It's just above the average wage of 29,000. So, if you are one of the most successful pension savers in the country, you'll end up with just a bit more than the average wage. This is hardly fat cat banker land, and yet you're being treated as if you're some kind of billionaire with this sort of treatment. Where it gets unfair is if you're in a defined benefit scheme, which fewer and fewer people are, but if you are, they are valued at 20 times your pension. So you would not bust the lifetime limit unless your pension was above $50,000 a year. So for me, I can only get $33,000 a year from reaching the lifetime limit. If you work for a local authority or you're one of the few people in a private sector defined benefit scheme, you can have a £50,000 pension. Some people might say that was unfair and that the tax system is skewed in favour of those people. I couldn't possibly comment. So, given all of the above, what should you do? Well, one thing to be aware of is that when you make contributions to your pension, you get tax relief at your highest income tax rate. This is one of the things that's been rumoured for years to be going to be taken away. Now, there are all kinds of reviews that Rishi Sunak has started, as well as the actual announcements in the budget. Just recently, we had something called Tax Day, because so many tax reviews were started on the same day in March. They will report back in the coming months, and you can bet your bottom dollar they will result in new taxes and new changes as we go into 2022. So we have a little bit of time to think this through and take some action. One of the things you should be aware of is carry forward. Maybe you've not been making much in the way of pension contributions, depending on whether you've had good or bad years in your business or whether you earned that bonus in your job. The point is, as of today, you can carry forward unused allowances from the past 3 years. So you could potentially be sitting on £120,000 of contributions that you could make at your highest rate of tax now and get those into your pension pot before this long threatened change of removing these higher rate reliefs. That's one thing you could do if you've got the cash. So what I suggest you do now is have a think about exactly where you are with your pension pot, the kind of performance you're seeing over recent years in your portfolio, and where you need to do your own pension forecast as to when you're going to hit this lifetime limit. Is it within this 5-year period where it's going to stay at just over $1 million? Chances are, if you can start getting into some of the hotter investment sectors, if you've been in Tesla, if you've been in Google, if you can get into some of the crypto firms as they go public, you could end up with a stellar push in your account that takes you much closer to this limit. So you're going to have to start managing this carefully as you start potentially running out of headroom to below that lifetime limit. Be aware of what the tax penalties are. More and more people just like you are falling into these tax penalties. They are there, I think, cynically and deliberately to trap you and to catch you out. The other thing to be aware of is at what point you decide to start taking any money out of your pension. It has big impacts. If you're thinking that you're going to start going into drawdown, then forget any idea of continuing to make meaningful contributions. Think about how long you're going to live, how long you need this pension to last, and then you can think about that you've got the whole drawdown versus annuity decision, which is a separate video we'll have to talk about. So start getting on top of this. Look at where you are today, forecast where things are going to be. What is your crunch date for hitting that lifetime limit? Because it might be sooner than you think. Thanks very much for watching. I look forward to seeing you soon on another episode of Renegade Investor Academy. If you'd like to see some previous episodes, click here. Don't forget to like the video, subscribe to my channel, and ring the bell so you don't miss out on any future episodes.